Morning folks, let's have a bit of a didactic moment. People often ask me how I go about my hedging, and we've got a perfect example going on right now because we're in a hedged trade right now on natural gas. I just want to interject for 30 seconds. People often ask me, why on earth do you bother to hedge? Why don't you just take the loss, and why do you end up with two positions in opposite directions? What is the benefit of that? I'll give you three benefits super quickly. First of all, it pauses your trade, gives you time to think. You don't have to rush into decisions. Once that hedge position is in place, your profit and loss is locked, and there's no dramatic urgency to take action. That takes out things like fear and doubt and FOMO and greed and all the deplorable emotional problems that you might experience when you're trading. Most traders, 90% of them probably experience psychological problems. So you get to pause and you eliminate some of the psychological problems. Secondly, that pause also gives you a chance to reevaluate your technical analysis and perhaps redo your charts, relook at it from different angles and decide how you want to approach the trade when you're not under pressure. And thirdly, it's a really good tactic to use if you're convinced of the direction of a particular instrument, perhaps a commodity. Normally commodities are better, and things like the dollar yen. When you know that the market's going to be reversing at some point, you want to keep a position in that direction, but you're not too sure where the market turning point will be, even though you think it's pretty soon. So by hedging, you can just sort of sit and wait for those turning points to come and then adjust your hedges as they occur. I just needed to add that in because I didn't actually describe the whole reason for talking about hedging and why we actually do it in the first place. So let's have a look at this trade and see if we can work out how we want to approach this. I'll show you my approach. I want to say at the outset that hedging's not for everyone. It can be a fairly difficult and complicated sort of task, and you can get yourself caught up in the chop of the market and get in and out of hedges far too frequently. So let's just go through this one and see how I would approach this, because we are in this trade at the moment. So we may as well use this as a good example. So here are my positions. Let's just zoom in. I've got a green arrow and a red arrow in the chart and a green band in between. This green band is what I'm going to refer to now as the hedging zone. And here are our positions. We're long at 288. In fact, my order was in at 286 and a bit. And that was going back quite some time, about a week ago. And you can see what the market's done in between. We sort of went up a bit, dipped down, went back up, dipped down. And then finally in this last number of periods, we dipped down, we gapped over the weekend down to the support level. Now these two levels of buying and hedging are predetermined levels that I picked out from technical analysis. The purpose of this video is not to go through the TA part of it, but how to manage the hedge. The TA part of it we'll cover in other videos. But suffice to say, we're long at 288 and we short down here on the hedge position at 268. Now the hedge position is an equal and opposite trade. In other words, whatever position I took long here, I've taken exactly the same size short. Outside the US, you're allowed to hedge with most brokers on the same account in different directions on the same instrument. So I'm able to be long natural gas at 286 and also short natural gas at 268 on the same account and on the same instrument. I'm going to zoom out a bit here to show you my strategy on this. And I've drawn in here two lines. I've got a red line above us. That's the next resistance line at about $3. Then I've got a support line down here at $2.50. Once again, the position of these lines is determined by technical analysis. And if you followed my videos enough, you'll know why these levels are here. I'm not going to go into that in this video either. I'm going to use the path tool just to indicate my sort of strategy for this and give you three different options that could happen. So let's start with the first option. The first option is that we move down from where we are at the moment down to the next support level at around about $2.50. At that point, this hedge position will be in profit, whereas this long position will be deeper into the loss. However, no matter which way this market moves, as long as those hedges remain in place, it makes no difference to my P&L. Any gains on the hedge position as we move down will be offset by the losses on the long trade that we already have open. Scenario number one is that we move down to support there. I take profits on this short position. In that case, I'll be long from $2.50 with no hedge, having taken this one off, with a greater loss on this original long position, but that extra loss on the long position will be offset by the gains on the hedged short position, which I initiated at $2.68. So if we get to $2.50, I'll add that extra long position on there, and this short position will be covered for a profit. And in this case, I'll have two long positions, one from 286 and one from 250, with an average price of these two positions somewhere in the middle, around about the 270 level. If the market then begins to move up, I'll not only profit from the original long position, but also from the new short position from 250. And that's the ideal situation for a hedge trade. It doesn't always work out like that, of course, so let's start again. Let's get rid of that and that. return the hedge, and get rid of this down arrow. Now, the second scenario that could occur is that instead of moving down towards the next support, in fact, we bounce here and we begin to move up to the next resistance, closer to the area where we got into the long trade at around 286. Remember, as this market moves either up or down, at this point our profit and loss is not changing because we have an equal position in both directions. However, if we move back up to 286, our original long position will be at break even and our hedge position will be in loss, thereby rendering our net loss exactly the same as if we hadn't moved at all. The worst case scenario, of course, in this event is that the market keeps on moving up, dragging up our short position and our long position with it, and keeping our loss locked in place, which is obviously what we don't want because we want to try and make some profit from this market. So at some stage, if we do move up, we're going to have to decide if, when, and where we take this short hedge position off. Normally, I'll do that if we closed above our original long entry position, that's at 286. I'd then cover this short position, leave the long trade to continue, and perhaps even add an additional long trade with a stop loss or hedge once again below the low of this move that we've just experienced. So that's scenario 2, and counterintuitively, it's actually the worst case scenario because even though the market's going in the direction that we want, we're stuck with this hedged position, and at some stage we're going to have to take the loss on that. So in that scenario, we'd have two positions here, having broken up above this key pivot level, these levels here, back into the profit on our original position, having taken a loss on our hedged position, but making up for that with an additional position here. The other thing we could also do, you can see we've got this red line above us, which is the $3 level in this case, and if we break and hold above there on a 4-hourly basis, we might be tempted to add yet another position and place an additional long up there in order to take advantage of the break above the $3 level. So that's scenario number 2, and actually the worst case scenario, which involves taking a loss, but it will allow us to stack this winning trade as and when it goes in direction. First of all, by adding another long position the moment we stop out the short hedge position, and then adding another long position on the break above the key $3 level, and a hold above there, of course, on a 4-hour basis. Let's reset once again. So back to where we are currently. So we have our long position at 286 and our short position at 268 as we stand at the moment. I'm going to shift those along a wee bit. In this third case scenario, what could really happen, of course, is this sort of thing like this and messing about, and we could even get some false breaks outside these levels, that sort of thing. This is potentially a dangerous situation where the market just seems to chop and change all over the show and involves us getting chopped up in this hedge position. I said the second case scenario is probably the worst, and this one actually looks even worse. But when you're in this situation where the market's moving about, chopping up and down, breaking through levels, false breaks, false starts, it actually becomes easy to trade because one's sort of caught up in the cusp and the thrust of this movement going on, and one's able to navigate it quite easily. And that's often on a 4-hour candle by 4-hour candle basis. And remember, what I'm looking for at all times here is 4-hour reversal candles, key levels, moving average touches, perhaps even moving average crossovers, divergences, and chart patterns. With a bit of technical analysis prowess and the ability to read the markets, this sort of scenario is really, even though it looks like a nightmare and a bit of a spider's web, really not that difficult to navigate. So I've given you 3 different scenarios. Those are the ways I approach these hedges. Like I said before, hedging can be a little bit tricky and complicated, so if you're not used to it or if you're unsure, rather do a bit of practicing first and then come back to your live trades when you're feeling more confident with it. And you can also use this tool to manage your trades better when you get more confident with it. Well, I hope you enjoyed the video. Please give it a thumbs up, and if you did enjoy the content, please subscribe to the channel. I'll see you in the next video.